maybe they'll let gold rise organically, 8,000, and then revalue it either market to market because it's valued at 42.22 or maybe more. James Rickards talks about it. The CME Group opens a 24-hour-a-day 1-ounce contract that's non-deliverable, increasing the public's exposure to speculation as China's moving the other way. And the longer that we screw with the price of gold and silver, the more deliveries you'll see them take. And that's why they're arbitraging, keeping a price higher for over a year in silver and gold. But what if they let gold go to the moon? And first, they've been bringing in all this gold. Every $4,000 increase in the price of gold would give the Treasury general account $1 trillion free and clear that he will issue gold-backed treasuries, 50-year to begin. In her book, she says 50 to start with a very low coupon and then 5, 10, 20, and 30 with a zero coupon. The point of it is that he said, unless we find a way to produce and reshore manufacturing, because being the world reserve currency through Triffin's dilemma says you can't have a trade surplus. The world needs more dollars than we can give them alone, and we don't trade enough with every country.
Which metal would you be buying right now? All of them have sold off. Which ones are piquing your interest? Gold, platinum, silver?
I like them all, and I own them all. I think silver has the best potential. I think platinum has one of the most interesting stories. But I think when the music stops, gold will be pegged to a new system globally. And I think if I had one trade, it would be gold. If I had two, it would be buy some silver and then switch it to gold when the ratio between the two correct. And my third choice is platinum. It has an interesting story, but, they're high premium items, and the U.S. Mint hasn't made a platinum eagle in, 3, 4, 5 years or longer. And I like it. It has an interesting story similar to silver, but it doesn't have the history that gold and silver do from a monetary perspective. Gold and silver cumulatively mentioned 700 times or more in the Bible. I mean, it's been wealth since biblical times, and kings and queens and emperors and pharaohs never owned gold to become wealthy. They owned it because it was immutable wealth that they could pass on to their future generations, and it's wealth. You own enough of it, you might be wealthy, but you don't buy it to become wealthy, and that's how I believe that to my core. Silver has the kind of potential that could make you wealthy if it goes to where it should go.
Most investors chase returns, yet history shows fortunes are usually preserved before they're multiplied. Andy Schectman notes that gold serves a different purpose than silver, but the deeper issue is whether today's financial system still deserves unquestioned trust. Silver may deliver stronger upside, while gold remains insurance against policy mistakes few investors expect. Wealth is often lost by confusing speculation with protection. Next, Andy Schectman reveals why institutional buying accelerated while retail investors were heading for the exits.
We saw a brief glimpse of that earlier in the year. And the sell-off, by the way, which the Bank of International Settlements called structural, not fundamental, meaning the CME Group, COMEX, raised margins by 300% into the end of the year. At the same time, the ETFs, the levered ETFs, all had to rebalance according to their prospectus to get things in order. And that means massive selling of gold and silver at the same time the CME Group raised margins to the roof. It blew up the price. And so as the price was getting kneecapped, China bought and the central banks bought more than it ever before and lied about it. And the deliveries on the COMEX off the charts, $20 billion worth of gold in February. Someone took possession of 26 million ounces of silver were delivered in February, which was a non-delivery month for silver. Every other month, I mean, you can still take delivery, but not a primary month. So 26 million ounces, call silver in February $70. What are you talking? Over 2 billion.
That's a lot of ounces.
39 million ounces left COMEX, got on trucks and drove away in February. That's almost 3 million pounds of silver, worth about $4 billion. Who did that? Who ran logistics for that, Daryl? How many VW Volkswagens does it take to put 39 million ounces of silver in it? Or how many semi-trucks does it take? And where did it go? Who insured that? And who took possession of it?
Billions of dollars in metal changed hands while most headlines focused only on falling prices. According to Andy Schectman, a 300% margin increase forced selling even as physical deliveries surged to unusually large levels. That divergence raises a harder question. were institutions exploiting temporary paper weakness to accumulate tangible assets. Retail investors often react to price while professionals monitor ownership transfer instead. Next, Andy Schectman exposes the hidden contradiction behind massive COMEX deliveries and official market narratives.
These are the questions that I think are the only ones that matter, is that as the price was getting destroyed and the public was selling, the smartest money in the world was backing up the truck and leaving, or just setting it in the exchange. Now, if it were the U.S. government doing these massive deliveries under the Exchange Stabilization Fund, under the privacy and shroud of that, sure, leave it in COMEX. Make it seem like nothing's changing. It's just the banks doing paper games. No, it's not. And they wouldn't care. No one's going to steal their gold. So I just happen to think that we are sitting at a crossroads right now where everything is going to change, but don't expect it to happen immediately. Just keep looking at this progression of events and the footprints that are leading to a new system where gold and silver have far greater importance than they ever have. Now, I wouldn't count platinum out, but to me, it would be number 3 on the list.
Curious in your thoughts on what ultimately happens with this paper market versus what's happening in the East, where China's trying to eliminate this whole paper speculation and everything.
I just think it slowly begins to move towards real price discovery. And, the trap that's right here in front of me is to say it happens immediately, but nothing happens immediately. I don't think that serves the purposes of them, but it begins to, over time, chip away at a system. Like, for example, at the same time China gets rid of their public's ability to speculate in futures and wants them only to buy physical.
Markets keep treating paper prices as reality, while physical demand tells a completely different story. What Andy Schectman is highlighting is the widening gap between speculative trading and actual ownership as Eastern markets increasingly favor physical settlement. Systemic change rarely arrives overnight. It advances through quiet structural shifts most investors ignore. Those waiting for instant confirmation often miss the transition entirely. Next, Andy Schectman unravels why China's strategy directly conflicts with the West's paper-driven model.
The CME Group opens a 24-hour-a-day, 1-ounce contract that's non-deliverable, increasing the public's exposure to speculation as China's moving the other way. And the longer that we screw with the price of gold and silver, the more deliveries you'll see them take. And that's why they're arbitraging, keeping a price higher for over a year in silver and gold than the Western price. So over time, price will move to, or volume will move to the best price. And I just think that, people will say, well, who will trust China, this and that? Who trusts the United States anymore? And look, I'm a patriot, man. I love this country. I truly do. I thank God every day I was born here. But the truth of the matter is that we look very dysfunctional. Let me give you an example of that.
Well, the truth of the matter is we got all these PhDs but no common sense, right?
Well, that's exactly right. There's like 35 congressional candidates running that are on the socialist platform. What?
Yeah.
That want to eliminate Congress, want to eliminate the jails, want to, over time, eliminate the jails, allow all the people in this country here illegally to have, to be sovereign immunity. You're in. And become pathway to becoming citizens. They want all the corporations to be owned by the government. They're moving towards a socialist agenda. You can't make it up. But I don't know. I think that this is a situation where you are going to see a view of...
The biggest risk isn't who controls gold pricing tomorrow, but who investors still assume controls it today. Andy Schectman's argument suggests liquidity naturally migrates toward markets offering greater transparency and efficient settlement, regardless of political preferences. History shows capital follows incentives, not patriotic narratives or media headlines. Investors ignoring that migration risk, misreading where future price discovery ultimately develops. Next, Andy Schectman reveals why delivery, not derivatives, may determine the next financial power center.
Of the United States that won't be the epicenter for price discovery of all of the commodities that the West has controlled for a very long time. And I just think that it's moving in a direction where transparency, immediate delivery, same day settlement, and in another currency will give legitimacy to an exchange very quickly. Maybe that's part of the reason you saw a good portion of the J.P. Morgan trading desk move to Singapore. I don't know, just throwing that out there. I think the Western system, which has for years operated under the theory that no one would stand for delivery, the fact that we're seeing these deliveries is creating a big problem, because you can sell and sell and sell and sell the same contract over and over and over again if you know no one's going to stand for delivery, and that's what's changing the system. Mm-hmm. And a lot of it is flowing to the east, and I don't think it's about as much metal flowing to the east as it is a new system migrating from paper rehypothecation to same-day settlement. And it's a big deal, Daryl. It truly is. And
yeah,
I guess we'll see how it all plays out, but that is my feeling.
Yeah, for sure. I mean, my thoughts are 20 years down the line, gold's going to be a lot higher than where it is today. And so that's
no question about that.
How I look at it. So I'm buying and sitting tight.
Major financial transitions usually become obvious only after capital has already moved. This is where Andy Schectman's thesis shifts from metal shortages toward the mechanics of settlement and ownership itself. If paper leverage gradually loses credibility, pricing power could migrate faster than most portfolio models anticipate. Long-term investors should watch settlement trends as closely as spot prices. Next, Andy Schectman exposes why decades of paper leverage may be approaching a structural limit.
I never said there would be a gold revaluation. I said they could. James Rickards talks about it, gold being revalued, that they wouldn't even need congressional approval. The president would just tell Treasury Secretary revalue gold, who tells the Fed, and they issue new gold certificates. And every $4,000 increase in the price of gold would give the Treasury general account $1 trillion free and clear. That, you know, guys like Luke Groman said, yeah, maybe they'll let gold rise organically, 8,000, and then revalue it either market to market because it's valued at 42.22 or maybe more.
Yeah.
Now, that's the first piece. I never talked about July 4th. I was asked, do you think there will be a reset on July 4th? No, I don't. I said, now, as far as Judy is concerned, she's one of the most brilliant people I've ever met in my life, Judy Shelton. I've interviewed her twice. I interviewed her once, and Michelle McCory, my co-host, interviewed her the other time. She's brilliant. She was Trump's nominee to run the Fed. She wrote a book, bestseller, Good as Gold. She's on X. She's on interviews left and right.
Yeah.
And she said to me, on my video, Andy, in no uncertain terms, when I was on President Trump's transition team, we discussed this at length. And he told me July 4th would be the most important day of his presidency, the 250th anniversary.
One policy decision could alter government balance sheets without creating a single new ounce of gold. Andy Schectman notes that revaluation remains a possibility rather than a prediction, yet investors often confuse scenarios with certainties. The more important takeaway is how seriously respected policymakers continue discussing gold-backed mechanisms behind the scenes. Ignoring those conversations may prove more costly than dismissing them outright. Next, Andy Schectman reveals why gold revaluation remains part of serious monetary discussions.
And I believe there is a very, very good chance that he will issue gold-backed treasuries, 50-year to begin. In her book, she says 50 to start with a very low coupon, and then 5, 10, 20, and 30 with a zero coupon. You want to talk about bringing back manufacturing, using a company like Tether, the price to go to the moon, sell it to the Treasury to back the back end of the bond, and the price goes up. A long-dated instrument would be easy to pay off as gold continues to go high. I think it is the best idea I have ever heard to get us out of this system. Look, my mentor, Richard Russell, God bless him and God rest his soul, said 10 years ago, 15 years ago, that we're screwed. We have two choices. We can inflate or die. And I said, why is it that way, Richard? He said, because we consume more than we produce. We're consumers, we're not producers. And if you consume more than you produce, Well, that means you're spending more than you're earning. So your indebtedness never gets resolved. So you either inflate or default. And so remember I mentioned there's never been a country to come back from 300% debt to GDP. If you add our unfunded liabilities of 175 trillion in Medicare and Medicaid and Social Security, we're way over 300%. That's why it's not on the balance sheet.
Debt becomes far more dangerous when economic growth cannot keep pace with future obligations. According to Andy Schectman, proposals linking long-term bonds to gold deserve attention because they attempt to solve structural rather than temporary fiscal pressures. Whether such policies emerge or not, inflation remains a persistent threat to purchasing power. Investors protecting wealth should prepare for multiple outcomes instead of betting on one. Next, Andy Schectman exposes why debt mathematics eventually overwhelms political promises.
But the point of it is that he said, unless we find a way to produce and reshore manufacturing, because being the world reserve currency through Triffin's dilemma says you can't have a trade surplus. The world needs more dollars than we can give them alone. And we don't trade enough with every country to give them enough dollars to buy energy alone. So you find a country like Cambodia, who we don't trade with, well, they have to sell their currency in the open market to buy dollars to buy oil. This creates a massive discrepancy over time. And so someone says, let's send our manufacturing to Cambodia. We'll make 10x. And that's how the manufacturing gets eviscerated in the world reserve currency. That's why China doesn't want to be a world reserve currency. They have too big of a manufacturing stake. They want to issue something parallel to the dollar and not be the reserve currency, I believe. And I think nor does Vice President Vance, who's talked about it for a long time, or the previous economic advisor of the Biden White House, Jared Bernstein, wrote a report, Dethrone King Dollar. We can't be the reserve currency, he said, anymore because of Triffin's dilemma. Vance said the same thing twice that I've heard. The point of it is that she's spot on. And I hope that they do it. Now, the problem was, and I never said I believed it would happen. I said Judy told me, and I believe her. And if it happens, that would be amazing.
Yes, it's possible.
The world's reserve currency delivers privileges, but it also carries costs rarely discussed in public. What Andy Schectman is highlighting is that Triffin's dilemma creates long-term trade distortions regardless of political leadership. That explains why multiple policymakers across different administrations have questioned the current monetary framework. Investors should focus less on partisan debates and more on structural economic incentives. Next, Andy Schectman unravels why reserve currency status may be both America's greatest strength and weakness.
I think relying on a date is a big mistake. It just is. And because you're going to be unhappy 99% of the time.
Yeah. So, Andy, you're a stand-up guy. I appreciate you. You operate with integrity. And, I think that, we're all getting these data points and we're all trying to make meaning of it and kind of speculate and what is our best guess of what's going to happen with this. And you were engaging with someone who is in circles that we're not in and getting information that
smartest lady I've ever met, the smartest person I've ever met.
Yeah. So we're
and so I took, I just simply said, look, she said it in her book. She told me twice. She says it in all these interviews. It would be amazing. And I think it's a great idea. And I still do. I think it is a way for us to reshore manufacturing. Yeah,
and it can still happen, right? Maybe there's some logistics behind the scene that we don't know of, and they couldn't do it by that date or whatever.
Well, let's hope so.
It still could happen.
Rising gold is what devalues the dollar because it is the only neutral reserve asset. You measure it against any asset or any currency. Measuring against the dollar index is a flawed measuring stick. They're all devaluing their currency against the dollar. That's Triffin's dilemma. What if they let gold go to the moon? And first, they've been bringing in all this gold.
Markets rarely reward investors who anchor decisions to political calendars instead of economic realities. Andy Schectman's argument suggests timing predictions matter far less than understanding the forces gradually reshaping the monetary system. Gold's role extends beyond price appreciation because it measures confidence in fiat currencies themselves. Patient positioning often outperforms chasing headline-driven expectations. Next, Andy Schectman reveals the overlooked metric that changes how investors should view dollar strength.
No one is asking who the hell is standing for delivery for billions and billions and billions and billions every single month for the last 19 months when nobody did it. And silver. Now, if it were percent, the Exchange Stabilization Fund, if deemed critical for national security, like silver is a critical mineral, and you could say gold is critical for where we are going, they don't need congressional approval. Take massive possession, leave it in COMEX. The naysayers say, it's just metal moving back and forth. I disagree. It's never happened this way. Never. So what if it was, in order to reindustrialize the country, you need a weaker dollar? Triffin's dilemma. In order to pay down the debt, you need a weaker dollar. And higher gold would enable you to do this, to reshore manufacturing in a much weaker dollar. In other words, the way they can soft default on the reserve status would be to let gold go to the moon. And part of me feels like that is what they are going to do. Now, that's supposition. What is real is the fact that we are now seeing same-day settlement exchanges in the global south, same-day settlement in Singapore, same-day settlement in Dubai, same-day settlement in Hong Kong. The difference between the three is Hong Kong will be same-day settlement in yuan. You don't have to convert to dollars first. It's the first time that an exchange will challenge the Western setting of price. They will be able to do so in yuan. So any company or bank stupid enough to naked short on COMEX will see an exchange for delivery to Brinks Hong Kong, which is a COMEX contract. Mm-hmm. And they'll bang, just make that arbitrage. Go for it. Send us everything you want. And that's what we've seen for the last year with all of the higher prices in Shanghai, where a trader can take 10 million ounces of silver and ship it to Hong Kong, where it's picked up by a truck and brought to Shanghai at a $12 per ounce spread, makes 120 million bucks. Off you go. Have a great day. But those arbitrages are supposed to end quickly. It hasn't. It's been going on for a year now.
Persistent arbitrage opportunities usually signal a market structure under growing pressure rather than temporary inefficiency. This is where Andy Schectman's thesis shifts from speculation toward global settlement infrastructure, challenging traditional Western pricing mechanisms. When price gaps remain open for months instead of days, institutional incentives begin changing beneath the surface. Investors ignoring those signals risk focusing on yesterday's marketplace.